Next approach is the earnings multiple approach. So in understanding the earnings multiple approach, first you have to get the market value of the equity of the firm. Okay, then the market price is compared with any standard metric like earnings, sales, cash flow, book value. So if you take the market price, if the market price is P, and then you will compare the market price with earnings, that is P by E ratio happens. If you compare price with the sales, then P by S ratio comes. Then if you want to compare it with cash flow or book value, P by B value comes. So all this we are going to understand now. What is relative valuation? So we calculate ratios now based, that is P by B, that is P by E ratio, PE ratio, P by B ratio, P by S ratio, price to sales ratio. Okay, these ratios is compared with the industry standard. So that is why it is called as relative valuation. See, relative valuation believes that it is possible to determine the value of a firm by comparing with similarly placed firm. Okay. So the first one in this concept is the earnings ratio. So price, that's what I told you, when the market price is compared with earnings, that's why it's called as price to earnings. Price divided by earnings per share. So price of the stock divided by earning per share of the stock for the period is known as the price to earnings. See, all these earnings ratios can only be calculated for a particular period. It is very dynamic. If you say quarterly, you will get a P by E ratio for the quarterly, half yearly, annual, or at any particular point of time. See, P by E ratio generally says, see, this is the price of the market. Today, if the market of a particular equity share, X company is trading at 100, and the earnings, that is dividend given by the, or the earnings per share is 10 rupees, it means people are ready to pay 100 rupees for a 10 rupee value. So that is what it says. P by E ratio says how much an investor is ready to pay for the earning. Suppose if the P by ratio is 10, then the investor is ready to pay 10 rupee for every 1 rupee earning of the company. Why we pay 10 rupee for every 1 rupee? Because we have got confidence in that particular company, that the particular company is going to grow steadily, hence you will make profit. See, earnings growth will result in increase in price. See, it is a snowball effect. If the earnings increases, more and more people would like to invest in that company. Company will get more liquidity, and hence the company sales will increase. When the company sales increase, the company valuation will increase. Hence the price, market price increases. So price to E, P by E ratio is based on this concept. So then in that case, we should know forward PE. That is, after 1 year, what is going to be the PE. So the forward PE is calculated by summing the estimated earnings per share of the future time period required and dividing the price by that earning, EPS. So what they do is, if you want to calculate the forward PE, they will just estimate the future PE based on the previous earnings per share, historical earnings per share, and they will make an estimated guess what will be going to be the earnings per share for the next 5 years based on the growth they have seen in the EPS for the previous 10 years. And that, if you divide the present price, you will get the forward PE of the company. PE ratio of the firm is compared with PE of the Nifty 50 or the any sector. Suppose if you are considering an automotive sector, what will be the PE of the automotive sector? And finally, its competitors, whatever is the competitor which you are going to analyze. Suppose if there are in automotive, there are Mahindra and Mahindra, there are n number of companies. So if you want to buy a particular company in auto sector, so you have to find out the PE ratio of its competitors and the PE ratio of the entire sector. And then if the PE ratio of the company which you are going to buy is less than the others, then you can say that this company has got more intrinsic value and you can go and buy that company. Now, how to determine the P by E ratio? See, P by E ratio is determined by using the dividend discount model, which we discussed earlier. Again, see, that's what I'm saying. We will keep going back to the dividend discount model again and again, because every calculation in the equity valuation is done through dividend discount model. So in stage 1, you calculate the dividend discount for the constant growth. What is the constant growth dividend model? D 1 divided by R minus G. Okay, so P0 is equal to D1 divided by R minus G. R is the rate of return and minus G is the growth rate of the dividend. So here now we are considering D1, that is the dividend is nothing but the earnings per share minus the plowback. I have explained what is plowback. So if the earnings per share of a company is 10 and if the company is giving a dividend of 5 rupees, the 5 rupees will be the plowback. The company is not giving another 5 rupees. They are keeping it with them. That is called as plowing back. That is keeping the money back, which is actually the investor money. So D1 is equal to earnings into 1 minus plowback ratio. It is simple. See, dividend will be, you have to reduce the plowback amount. So 1 minus plowback ratio, if you put the plowback percentage as 0.5, so earnings will become, naturally will become 50%. So let us say B as plowback ratio. So dividend D1 will be equal to earnings into 1 minus. E1 is nothing but the total earnings after 1 year into 1 minus the plowback ratio. So the present value of the company will going to be earnings after 1 year into 1 minus the plowback divided by R. R is what? Rate of return minus return on equity. See, return on equity I have explained in detail. You can go and check in part 1 and part 2. Return on equity star, that is multiplied by the plowback ratio. So if you multiply plowback ratio into the return of equity, you get the growth rate of the dividend. Okay, so that is R minus G, it should come here na. So that G is nothing but your ROE, return of equity, into the plowback. Okay, now G is growth rate, which is nothing but ROE into B. That's what I have just explained. So the present value of a company equity share will be equal to E1 into 1 minus B divided by R. Divided is not here shown. R minus ROE into B. Okay. Now coming, see, 1 by B indicates the plowback ratio, which I have already explained. If the return on equity is greater than the rate of return, the required rate of return, then P increases with the increase in the plowback. So price to earning will increase. The more the plowback, the company takes the money from you as from the earnings, then the price to earning ratio will increase if the rate of return is greater than the rate of return. Rate of equity is greater than the rate of return. It's very common sense. The rate of return on equity is higher than the rate of return. Naturally, the PE should increase. If the rate of return is less than R, that is the if the ROE, that is return on equity, is less than rate of return, that is R, then the PE decreases with increase in. So the more you plow back, you are getting less return on equity than the rate of return which you want. Naturally, the PE will reduce. Now coming to PE ratio and interest rate. See, there is an inverse relationship between PE and expected rate of return. Suppose if you consider P and risk, what will happen? See, the riskier stock will have a higher required rate of return. Hence, if there is a higher rate of return, then the rate of return on equity should also match the rate of return. Okay. Hence, the PE ratio of company having higher risk will have higher rate of return. Hence, their PE will always be less. For any expected earnings and dividend stream, expected earnings and dividend stream means we know what is going to be the earnings for the next 5 years and we know what is going to be the dividend which we are going to get. Then the present value of dividends will be less with higher required rate of return. So more will be the rate of return, the present value of dividends will come down. This is a very common sense concept. Now coming to P ratio and liquidity. See, stocks with higher liquidity command higher P naturally. If you are, higher liquidity means you should be able to buy and sell stock in the stock market very easily. That is called liquidity. So higher the liquidity, so the price to earning ratio, earning multiples will be higher. Size of the company will also have a direct impact on the PE. A better managed, high productivity company will generally have a higher PE multiple. Next, coming to the rule of thumb for identifying the correct P by E ratio. How do we identify which P ratio is better? There are so many companies, bigger companies, smaller companies. You cannot just say company with higher PE is a good company. So if the company with PE of 100, how do you know the company is actually earning is commensurate with its total capital investment? So the first thumb rule will be, take the earnings estimates first. That is, what is going to be the earnings for the next 1 year or 5 years. Then PE will be almost equal to projected earnings growth. So if the PE ratio, that is price to earning, is divided by the projected earnings growth. See, PE is for any particular period. You must understand. I have already explained. PE is for yearly, or for any period of time you want to calculate the price to earning ratio. It is only for that particular period. By earnings growth can be estimated using the historical earnings of the company and what are the future projects taken up by the company, and what if suppose if the company says, okay, we are going to develop semiconductors in the next 5 to 10 years. So experts will estimate what will be the total amount of investment made, and if the company establishes a semiconductor plant, how much more revenues which are going to come and how much profit it are going to make. Based on that, they make an educated guess of the earnings growth. So if you divide the earnings growth by the present P ratio, you get what is known as the PEG ratio, that is price to earning growth ratio. If the price to earning growth ratio is greater than 1, the stock is overvalued. If the PEG ratio is less than 1, stock is undervalued. And if the PEG ratio is 1, the stock is fairly valued. Now the second thumb rule is, it takes the inverse of prime interest rate in real terms into consideration. What is prime interest rate? Suppose if the present prevailing interest rate in the economy is 6%, as I have explained, or the inflation rate, then PE ratio will be 1 divided by 0.06. So generally it will be considered that the correct estimate of the PE ratio is 16.67. That is, you have a PE multiple of 16 generally. So you should be giving, you should not give more than 60 rupees, 16 rupees for every 1 rupee invested in the company. So this calculation is based on the assumption that the equities represent claim over real assets. Okay. Because we are considering interest rate in real terms, hence we should say the equity claim will be only for real assets, not for intangible assets. Now coming to the price to, so what I will do is, I think there is some other thing. We will just put everything and then I will explain. All right. Okay. Now, price to book value ratio per share is the net worth of the company. Net worth, we know, total assets minus total liabilities. That is the net worth. So net worth of the company divided by number of equity shares outstanding is the book value per share. The price to book value is nothing but the market price of the company divided by the book value per share. That will give you the P by B ratio. P by B, that is price to book, is usually used in valuing financial services and banking stock as the assets are marked to market. We will not go into the details of why we are using the word assets are marked to market, because as far as banking services is concerned, banking services is involved in lending. Okay. So most of the banking services, lending interest rates and deposit interest rates are linked to the RBI interest rates. That's why they are called as mark to market. One limitation of book value is that the assets of the company are valued at historical prices less depreciation, not at the economic value of the assets at one particular point of time. If you want to know more about, again, you go to part 2 and part 3 of my equity valuation. Here, non-tangible assets. Non-tangible means anything you cannot touch are non-tangible assets. So non-tangible assets, the intellectual property rights, proprietary, then copyrights, they are all intangible assets. So it is very difficult to assess. Hence, in accounting valuation, these assets will never be considered. So how do you determine PB ratio? Price to book value is D1 divided by, again, the discount dividend discount model of the constant growth rate, where D1 is the expected dividend for the next period, and E0 represents the earnings per share, and E1 represents the expected earning per share, and D blowback rate, and G growth rate of earnings. We will come to that. See here. Now, E1 is the earnings for the next period, will be equal to earnings for the present period plus the growth in the earnings. G is nothing but the growth in the earnings. So the dividends will be equal to this E1 earnings for the next period into 1 minus the plowback. Whatever the company retains itself is the plowback. Okay. So your dividend for the next year is going to be equal to this one, that is dividend for the present period, into 1 plus G, that is the growth rate, into 1 minus B. 1 minus B is the plowback rate. So your present value is going to be E0 into 1 plus G into 1 minus D divided by R minus G, where G is the growth rate. Here return on equity is equal to the present earning. Okay. Return on equity is nothing but the present earning. So price to book value can also be written as return on equity into 1 plus G into 1 minus B divided by R minus G. You must be wondering how ROE is equal to earnings. You please go back to part 2, you will get the answer. Higher the return on equity, higher will be the price to book value. Now coming to price to sales, this is a more realistic, where here earnings are not concerned. Here actual sales of a company is taken into consideration. So here market capitalization, a very profusely used word in the financial market is market capitalization. Market capitalization is nothing but present share price. See, market capitalization changes every day. Okay, because the share price changes every day. So share prices into number of shares outstanding will be the market cap. Then you must be asking the question how market capitalization is considered. So if you want to do some calculation for over a period of 1 year or 6 months, what they do is they take the average share price into the average number of shares outstanding at that for that particular period, and then they come to the conclusion of the average market capitalization for the period in which they are going to calculate the price to sales ratio. Okay, so it is nothing but sales divided by revenue is calculated for 12 months. I told you. So sales oblique revenue is calculated for 12 months. So price to sale ratio is nothing but market capitalization, which we have calculated here, divided by sales for the previous 12 months. That gives you the P by S ratio. See, P by S ratio is less prone to manipulation as earnings are not considered here. So here earnings doesn't come into picture at all. It is the sales which is coming into picture. So P by S ratio can also be used to value firm with negative profits or companies who are involved in high volume, low profit margin business. So what it says, generally says, is we are not going to consider the earnings. We are just going to consider the sales. So when you are considering sales, you can, basically this is a ratio, right? So when you are having a ratio with respect to sales, whether the company is big or company is small, everything gets evened out in a ratio. So that's why price to sales ratio is a more, you will be able to value firms even with other companies which are having negative profits or who are involved in high volume, low profit margin business. P by S ratio considerably less than 1 is considered as a bargain buy. However, it has to be compared with Nifty 50 or sector or industry average before taking any further confirmation. Basically, see, P by price to sales ratio means it is a bargain sale, bargain price, right? You are paying less price for a company which is having higher sales. Less than 1 means. So that can be happening for different reasons also. So then you have to make a comparison with Nifty 50 or sector or industry average to see whether it is actually correct or not. P by S ratio is driven by the profit. Hence, P by S ratio to net profit margin will be a better ratio. One more view. So how do you determine P by S ratio? Again, we are going back to the dividend discount model. The present value of the equity share will be equal to present earnings plus the earnings growth rate 1 plus G into the flowback divided by R minus G. Here present earnings will nothing but net profit margin into sales per share. Whatever sales per share is happening into the net profit margin will give you the earnings per share. So price to sale ratio is nothing but net profit margin, because you are taking E0 here. Sales will go back to the left hand side. This sale on the right hand side will go at the denominator of the left hand side. Okay, that is P0 by S is nothing but the net profit margin into 1 plus G into 1 minus B divided by R minus G. Now net profit margin into sales will be per share will not be considered, because sales per share will go to the price per share. Okay, so P by S will be is equal to net profit margin into 1 plus G into 1 minus B divided by R minus G. Now coming to the economic value added / economic profit. See, it tries to measure the true economic profit produced by the company. Economic profit is what? It is operating profit. You reduce tax out of it and you reduce invested capital into the cost of capital. Suppose you have invested 1 lakh rupees and the cost of capital is 10%. So 1 lakh into 10% is nothing but 10,000. So you reduce 10,000 from your operating profit after deducting tax to come to the economic profit. Okay. So this measure helps the investor to ascertain whether the company has produced value for its customer, because you are deducting the cost of capital also. Now coming to market value added. See, this is another measures of relative valuation. Market value added will be equal to current market value minus original capital contributed by the investor. When the company is installed, whatever the original capital contribution which has been done by the investor, that is reduced by the current market value to come to the market value added. If the market value MVA is greater than 1, the look is positive for the company, and it is less than 1, the look is negative. Now the next ratio which we are going to discuss is EBIT by EV. EV is enterprise value, EBIT is earnings before interest and taxes ratio. See here what EBIT means, earnings before interest and taxes. That earnings calculated without deducting the interest to be paid on borrowings and taxes paid. EV means enterprise value. See, enterprise value takes both equity and debt into consideration. See, EV tells how much money is needed to buy a particular company at that particular point of time. So enterprise value is given by the market capitalization. We know what is market capitalization. Market price into total share outstanding plus total debt. What is the debt outstanding with the company minus all cash and cash equivalents deducted. That will be the enterprise value. So EV takes both the equity and debt into consideration. Equity is taken into consideration from market capitalization, and debt has been taken into consideration by adding the total debt. EBIT or EBITDA / EV multiple is usually used to compare companies with different capital structure. See, different capital structure means some company may be capital intensive, some companies may not be. Suppose if you want to see IT firms have a different capital structure, auto industry has a different capital structure, pharma industry has a different capital structure. Pharma industry will pay more for R&D, research and development. IT pay more for employees for software development, but auto companies pay more for the manufacturing. Higher the multiple of EBIT to EV, better the company financial. However, again this needs to be always be compared with the industry average. Now coming to enterprise value to sales. See, whenever you are taking EV to sales, it is always a better measure. So this ratio enables a company to be analyzed based on the sales while taking into account both equity and debt. Because enterprise values consider both equity and debt, and sale, as you know, is a very good measure for companies' prospects. So this is more reliable than price to sales ratio, as it does not take debt into consideration. So P by S does not take debt into consideration, whereas EV, enterprise value by S, take into consideration. And finally, we are coming to what is known as the dividend yield. Dividend yield is nothing but dividend per share divided by the market price. It is the a ratio. It generally says as a thumb rule that any company paying dividend is profitable. Earnings yield is earnings per share divided by the market price of the share. This can also be used to determine whether a company is under or overvalued. Earnings yield should always keep decreasing. If the earnings yield is less, then you should buy the company. Now let us understand PBV to ROE matrix. These are price to book value to ROE matrix. Suppose if the price to book value is high and the return on equity is low, generally the company is overvalued. But if the return on equity is high and price to book value is low, then it is undervalued. Low ROE and low PBV and high ROE and high PBV is generally not considered for buying. Next comes growth to duration metric. Duration is nothing but 1 over the dividend yield is called as the duration. So you have to understand what is duration. Whatever is the dividend yield which you are getting, so if you divide 1 by the dividend yield, you get the duration. If a company is undervalued, if the expected 5 years EPS growth is high, whereas the duration is low, then it is undervalued. Whereas the expected 5 years growth is high and also duration is high, it promises of a good growth. And if the expected 5 years EPS rate is low and the duration is also low, they are called as dividend cows. I'll tell you why. Dividend companies will have a very constant dividend payment ratios. Hence, the duration will always be low for dividend paying companies. And finally, when if the duration is very high and the expected 5 years EPS growth is low, then that company is overvalued. Now coming to market cap to GDP ratio. It is the ratio of the market capitalization of the company versus the GDP of the country. This is basically a Warren Buffett model. I am just putting it all this, just to make you understand that there are so many metrics available to value a company. That is all. You can use any of these metrics with due consideration. So if the ratio is less than 50, then the company is significantly undervalued. See, we know what is the GDP of a country today. You will get GDP estimates every quarter or every 6 months GDP estimates. You can take the market capitalization of the company through the balance sheets, and you can generally calculate it also. It is already readily available. So when you find these ratios, if you find this ratio less than 50, the company is significantly undervalued. You can go and check it up. It is very easy to find the market cap and the GDP. You check out, you take about 5 to 10 companies and try to correlate it. If the ratio is 50 to 75, then there is modest undervaluation. And if the ratio is between 75 to 90, it is fair valuation. If the ratio is between 90 to 115, it is modest overvaluation. And finally, if the ratio is greater than 115, the company is significantly overvalued. Now coming to the most important point, what are the shortcomings of the financial statements? See, based on the financial statement analysis, we are doing all these valuation matrices. Okay, so what are the various shortcomings? In annual reporting requirement, company has to make a forecast for 1 year, which is quite long for uncertain long-term projects. So when the project is very long-term gestation period, in such cases, making an estimate or a forecast will be very difficult, because everything is basic. We are talking of dividend estimate, earnings estimate, sales forecast, earnings forecast. Everything is based on forecast. All these earnings estimates and all will come from your balance sheet and profit and loss account only. So you have to understand how objectively you can utilize all these resources. See, inability of management to objectively itself make these choices. See, they have to make a very stiff choice between flexibility and consistency in making all the financial statements. They have to be very clear. The company has to be very clear, even if when they are not doing well, they should be able to project in their P&L account properly. There should not be any window dressing of their balance sheets or an P&L account. So finally, there are so many sectors. So if you want to generally compare different or diverse sectors, it becomes very difficult for an accounting rules to be applied to all these diverse sectors. As I have explained, companies should avoid doing window dressing. There will be lot of price level changes happen. So with these dynamic price changes happening, the financial statement analysis, you have to take it with a pinch of salt. So that's what we are saying. See, balance sheet figures generally get distorted because the accounting practices does not take into price level changes into consideration. There will be various variations happening in the accounting policies. Because firms have been given latitude in accounting treatment like depreciation. See, firm can decide on what type of depreciation method they can use, and how to value a stock, and how to write off R&D expenses and forex transaction. So all these company has got some leverage. So when the company is having the leverages on all these aspects of the accounting, then window dressing can happen. So what should be the guidelines for analyzing the financial statement? See, use ratio to get clue to ask the right question. See, ratio by themselves do not provide any comprehensive answers. So you should use ratio only as a guideline. And you should not be using each and every ratio which are there in the books or which I have explained just now. You should be selective in the choice of ratio. Keep a certain few ratios, and based on that ratio, make an informed decision. And it is also very important to employ proper benchmark. And we should be aware of various tricks and window dressing methods used by the accountants while publishing the balance sheets and the statement, financial statements of the company. It is very important to read the notes to the account, in financial statements. See, financial statement analysis, as I have explained when we started, is a mixture of art and science. So going beyond numbers, see, till now we have discussed only numbers, formulas. Beyond numbers, what should we consider? Are the companies tied to one customer? It is very important. Or whether the company has got a diverse products, or it is tied to one type of customer. That will also, you will just generally get a view of how the company is going to function in the future. To what extent are the company's revenue tied to one key product? Whether the company is dependent on a single supplier. See, supply bottlenecks can thwart the company's earnings and the company's sales. So we should be aware whether the company has got single supplier or different suppliers. And what is the percentage of company's business that is generated overseas? That will also have a huge impact, geopolitical impact on the earnings of the company. What is the competition faced by the company, and what are the future prospects of the company based on the any technological changes which are happening? All these things have to be considered. So this is about the complete financial analysis. I hope you had you will have a very nice understanding of this, and I will hope you learn something from this presentation. Thank you very much.